Here's what's coming up on today's show.
The key to tax planning is to always pay taxes at the lowest rates and be able to control the taxes you pay. Once you hit RMDs, it's out of your control and you're constrained.
This is the Retire Happy podcast with John Amarino, a fiduciary financial advisor at Securus Financial in the San Diego area, and Thomas O'Connell, president of International Financial Advisory Group, Inc. in Parsippany, New Jersey. Together, they'll be keeping retirement happy from coast to coast.
Welcome back to another episode of the Retire Happy podcast. I'm your host on the West Coast, John Amarino, and I am joined by my esteemed co-host and world traveler on the East Coast, Mr. Tom O'Connell. Tommy, how are you doing, sir?
Great, John. Great to be back. It's been a couple of weeks since we did our last episode. Super excited with our surprise guest today, a world famous advisor and mentor, as well as friend. So we're looking forward to the introduction and getting some great information today.
You had a big trip this summer to Korea. You took your daughter out there.
I took Emma to visit her grandmother, who she hadn't seen in many, many years. So we had a great trip to Seoul, South Korea. My hotel was directly across the street from the Chinese embassy. So that was very interesting. But all in all, it was a great trip.
That's awesome. Awesome. And I did see some photos of you sporting some world-class branded shirts of today's guest also.
That's right. As I do with every trip that I take, there's no stopping an Ed Slott IRA elite advisor anywhere in the world. No borders can stop us. So surprise, surprise. Our big guest today is the world famous Ed Slott, America's IRA expert, mentor, friend, and all around good guy, even though he's a Mets fan.
Well, can't have it all. The only thing is, Tom, I have to tell you, I'm a dedicated Met fan. I'm not one of those that only is a Met fan when they're in the World Series. I mean, I go back to 1962 when they couldn't even win a game.
I know you were a fan when Marv Thornberry.
That's right.
First base,
Marvelous
right?
Marv.
Yeah. So I'm the same way with the Yankees, right? I can remember when Celerino Sanchez was playing third base for the Yankees way back in the early 70s. So,
well, I was a Yankee fan up until the Mets started. My parents were from Brooklyn, and like everybody, they were so angry that they left the Brooklyn Dodgers. They wanted to root for another National League team.
right. Well, my dad had a rule in our house growing up that we had to be Yankee fans, so I didn't have a choice.
I was a big Roger Maris fan in '61, one of the great years of my baseball life.
And
Well, we all do have one thing in common, and that is one Juan Soto, who and you guys can have him. You guys can have him. We in San Diego did not like him. Now we now we have to painfully watch all of our great prospects with the Nationals.
That's all right. Well, and the other thing that a lot of people don't know about Ed, and we'll do the formal introduction in just a second, but Ed used to be in a rock and roll band.
Oh, no, don't go there. That was another lifetime. That wasn't me. Luckily, there's no internet back then.
That was his evil twin, I guess.
And ladies and gentlemen, it's today's guest, America's IRA expert, Ed Slott.
All right, so Ed, it's been a little bit more than a year since the last time we had you on, so thank you for coming on with us again. Greatly appreciate it. In that last year, we've had a number of changes, especially the big news with the big, beautiful bill that was recently passed. And so that's what we want to focus on today, and how that's going to have, what kind of implications that's going to have on folks' retirement.
Right. Well, it's great to be here, and it's great to be with you. People don't know well, maybe they do, but I'll introduce you to your own audience as well, that you've been studying this, not just taking a course here and there as a member of our Ed Slott's Elite IRA Advisor Group. It's a tax study group, advanced tax planning strategies all around retirement tax and estate planning for what may be what probably is your largest single asset, your retirement account. And Tom's been studying this for somewhere around 20 years with our group.
This year's my 20 year.
Yeah, 20 years of really going to programs, being part of our group, and it's amazing. And what's amazing to me, Tom, is when we do these programs, we have a number of advisors in the group, but very few as long as you. I look at advisors, like if you're a consumer out there listening, you say, I wonder if my advisor has that kind of training. The answer is no, probably. Why? Because they'd have to be in the top 0.1% of advisors that have that kind of knowledge. And that's true. Most advisors, they can help you make money, and that's fine. Everybody wants to make money. But when it comes to your retirement account, that means nothing unless you can keep it. It's what you keep that counts after taxes. You can't spend what goes to Uncle Sam. And unfortunately, the average advisor is only focused on what I call the first half of the game, the building, saving, and investing. But the big win is in the second half of the game when you apply the strategies to both preserve it, keep it, and grow it, and hopefully keep more of it for you and your family and less for IRS. And that's what Tom specializes in and has specialized in for probably over 20 years, 20 years that I know about it. That's a pretty good educational commitment. And one thing I always say about advisors when I'm talking with consumers, you don't want to invest with an advisor that doesn't invest in their professional education. And many don't. Many say they do because they give new investment strategies. But again, that's only half the game. This is the second half of the game when you are literally forced to take that money out. You've got to have a plan, and most people don't.
Right. Thank you. I appreciate those kind words.
No, absolutely
coming from
true.
you. It really does. We've been together a long time, and it's been nothing but phenomenal for me and for my clients, and it's been an honor to work with you.
And I like having our flag up on Mount Everest or Kilimanjaro and now Korea, wherever you go. I don't know what that's about, but I hear it's up there.
Just to prove that I was there, Ed.
Yeah, well, I'm not going to check. The confirmation, I have limits. I believe you.
Thank you.
Seen the photos.
And Ed, you mentioned the key thing you talked about, and Tommy and I are always on the phone with each other, sharing our different tax strategies, and it's taxes.
Yeah,
and I've seen, and Tom and I have both seen so many advisors that won't even talk taxes.
I know they even put it on their paperwork, their disclaimers. And I always, when I talk to groups of advisors, and they have on their disclaimers, oh, we don't do tax planning, we don't do to speak to your tax advisor, we don't touch, like it's kryptonite, they can't touch it. And what I say to them, well, then you shouldn't be touching any IRA money, because if you touch an IRA, you're doing tax planning. If you touch a Roth IRA, you're doing tax planning. If you're advising on a rollover, you're doing tax planning. If you're advising on a Roth conversion, you're doing tax planning. These accounts are loaded with taxes, and taxes will be the single biggest factor that will separate most people from their retirement savings. It will determine how much you keep and how much goes to the government. So any advisor that can't look at you like we're talking here and say, no, we actually do the tax planning around your retirement savings, those kind of advisors like the ones we train will help you keep more of your money. It's that simple.
Right.
Absolutely.
Tip only what you need to, but do not tip the IRS.
That's good. Well, you can tip the IRS. Does IRS actually get a deduction for tips they get?
Yeah. And I think what Vanguard, Fidelity, they've all done studies now about advisor alpha, adding almost 3%. And a major part of that is tax planning and the knowledge that you impart, with a lot of what you teach advisors around the world and people. And do you still have the most successful, are you still currently on air with PBS as the most successful retirement
Well,
show
we're
ever
not,
there?
we did it for 15 years, but during those 15 years, my producer tells me that we have been the most successful PBS show of all time. Not the most, I'm sorry, I should say, in the top five PBS shows of all time. Now, let's see what that means. It means it brought in the most in donations. So it doesn't really mean in other words, I could be juggling. If that brought in money, they would say that's a good show because it brought in money. But this brought in, I'm told, over $65 million to public television in small donations. So what does that tell you? What it tells me, it resonated with people who had retirement savings. And when I asked people, why are you watching this? Or why are you seeking out information on this? And they would always say the same thing. And I travel all around the country. They say the items, the tax planning for my IRAs and 401ks, the things you were talking about on TV. I wasn't getting this kind of information from my current financial advisor. So what does it mean when you use the word current?
The one you got now.
Yeah, it means you're looking for somebody that does have that information. So that's why it resonated so much. And that's why Tom and members of our elite group bring in quality business, because they attract people who are serious about helping keeping more of their retirement savings for them and their family.
Right. It is a close-knit group, too. And it's not just advisors within the Ed Slott organization competing against each other.
No, it's a family.
We work together. We work with each other, giving best practice and talking about different situations, and and helping each other for the betterment of of the consumer out there.
The consumer is always the winner. That's right. We always do what's best for the consumer. I say it in every program, because if you have the education and the tax planning knowledge, and another thing, Tom and every member of this elite group has us as back office support. Because the big advantage advisors in our group like Tom have over other advisors, they know they don't know everything. They know what they don't know, but we know the rest. The dangerous part for other advisors, they don't know that they don't know. So they don't know to ask, and they can be dangerous to your retirement savings.
Yeah, we've had Andy on here a number of times. Andy,
yeah.
And I probably reach out to him maybe like once a month on average, I would say. Just a clarification on something. And I can tell you, I always get an answer probably within 15 minutes of me sending him something. And I know that, he's got a lot of things to do, but the support that we get from your organization is top notch, second to none. It's just a great people from you all the way down.
And that's what we created, a community, family. And the reason I created this group over 20 years ago is because I saw in my own practice as a CPA that most consumers with retirement accounts were underserved. I kept hearing, well, my advisor doesn't know this, my broker doesn't know this, my attorney, my accountant is not, they can do taxes, but there's really no value there. If you think about it, there's a big difference between tax preparation and tax planning. Think about it this way. Tax preparation costs you money. Tax planning makes you money. That's a big difference.
Yeah. And just for the sake of transparency, I'm sure anybody who's listened to our show in the past, Ed doesn't sell products.
That's right. I don't sell I've never sold any financial products. I've always been a tax advisor because I believe that's where you can make people the most money, or lose them the most money. For example, the stocks go up and down. It goes down. All right. In a recovery, you get it back. If you lose money to taxes, you're never getting that money back. A lot of these rules are very complicated, and you may only have one bite at the apple to get it right the first time.
Great segue into the BBB.
All right. It's
Talk
the
about that big, beautiful bill.
One Big Beautiful Bill Act, or ABBA, which is why we played that ABBA song in the beginning, Money, 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 because we're calling it ABBA. So it reminded me of the group ABBA. But I'm changing the name now. Don't tell Donald Trump. I'm changing it to instead of OBBA, which is One Big Beautiful Act, I'm changing it to OBO, One Big Beautiful Opportunity. There
you
is
go.
tremendous opportunity in this bill. There's a little something sprinkled around for everything. It is a humongous bill, 870 pages, a lot of things that probably have nothing to do with a lot of people, but a lot of people can benefit. There's something for everybody. If I had to say the big game changer in this bill, and again, not everybody, but people in high tax states, the SALT, state and local tax, known as SALT, S-A-L-T, state and local tax deductions are back. They were limited in the years ago at the Tax Cuts and Jobs Act, and they were limited to 10,000, which, Tom, as you know, in New Jersey, me in New York, that didn't cover the real estate taxes on your bathroom in New York and New Jersey.
Right.
So now it's up to $40,000. There are income limits. So this is why you need to work with an advisor, a tax advisor that can coordinate your retirement planning, like, for example, a Roth conversion. Now, there are high limits. That one is temporary, but it's here now. As of July 4th, the date of enactment, the SALT deduction is back, and that would move many people, actually 90% of the people, Tom, in the country, after the Tax Cuts and Jobs Act, were taking the standard deduction because it was much higher and the itemized deductions were limited. Now you're going to find people in high tax states moving over to itemizing. Why? Because if you can get that 40,000, get up to 40,000 in some high tax states, that's a pretty good deduction. But that gets you into the arena, so to speak, the itemized deduction arena. Now you've got a ticket to enter, right? And the $40,000 just about gets you over the hump where it's a better deal than the standard deduction. Not always, because the standard deductions were increased as well. But once you can take advantage of the 40,000, and not everybody can, I'll get to that in a minute. 40,000, now it opens up, you can add mortgage interest, charitable contributions. So it opens up medical if you qualify, but things like that. Now the return is open to a lot more deductions. The flip side is people got used to the standard deduction, and one thing, they complained about losing all their itemized deductions, but remember, they got a doubled standard deduction. But they kind of liked the standard deduction because they didn't have to prove anything. You just got the deduction. Now we're going back to, if it opens up the itemized, you have to prove all those amounts again. So back to keeping good records and things like that. But the SALT deduction is up to 40,000. And I think it covers, like, I don't know the real number. Maybe you know, Tom. Would you say 95% of the people have income of 500,000 or less? Would that be a fair number?
I think that's more than fair number. Yeah. I mean, the 1 percentile is even higher than that, I think, right?
I don't know, but that's the cutoff. After 500,000, it phases out. At 600,000, you don't get any of it. So if you're in that 500 to 600, you really have to do planning because it phases out fast and it costs you a lot in breaks. So for example, if you're thinking about doing a Roth conversion and that might push you over the 500,000, I might think again and do a series of smaller conversions over time to not blow that big tax benefit, because that SALT deduction is only around for 25 through 29. So you want to really hit that for the years it's there, and you don't want to blow it with a Roth conversion. So if your income is generally under 500,000 and you're in a high tax state, you're going to see your itemized deductions take off and you'll save taxes.
Yeah, so I just want to emphasize that you're talking about Roth conversions, because even today, people still get confused about a Roth contribution and a Roth conversion. So we're talking about conversions where you're taking money already in qualified account, paying the tax on it and putting it into a tax-free account. We're not talking about making a contribution out of your cash flow.
Right. Yeah, and that's small money anyway. Not that I'm saying it's small, but it's limited to 7,000 or 8,000 if you're 50 or over. A conversion has no upper limit. It's only your pain threshold, how much tax you're willing to pay.
Right.
in terms of one thing I love about this one big beautiful bill is for a lot of advisors, we were sitting here going December 31st, 2025. We've got to get these Roth converted. It buys us time. Now we can.
Well, you know what? I wouldn't put the brakes on at all because yes,
Well, not so much the brakes, but we don't have
you don't have
to
to
be as
worry.
aggressive in
But I don't
2025.
want people getting lulled into a false sense of security. Keep up with those Roth conversions. You just have more years to do them. Now, here's an interesting thing. The extension of the tax cuts is permanent, but I want to define the word permanent when it comes to Congress. And what it really means is permanent until a future Congress changes it. So we don't know what really permanent means when they say it in the tax code. It's really permanent until it's not. So
Right.
that's what I'm saying. Take advantage of every year we have these low brackets. You never want to blow an opportunity to push Roth conversion money through these low 10, 12, 22, 24% brackets.
And even more so, we only have 7 brackets versus the 20 we used to have in the
Yeah,
80s.
yeah. That was crazy.
Bounce you up. So getting on to that, Ed, if we can just segue, since we're talking on the power of Roth conversions, obviously a lot of people do them for future taxes. What's your thought on the future taxes with the debt that we carry as a
Well,
country and what we're doing in DC?
look, unfortunately, as a CPA, I believe in math. Congress does not believe in math. In fact, I do a lot of crossword puzzles, and a strange word came up on it, which I learned. The word was innumeracy.
I was going to ask you about that because you talked about that at our last
Yeah.
conference.
Innumeracy. Innumeracy. I didn't get it. I got it on the crossword by getting other clues, but I looked it up. It means the inability to understand how math and arithmetic and calculations work. In other words, a mathematical illiterate. In other words, Congress. So I believe in math. Yes, of course, rates will have to go up at some point. I don't know how long you can keep kicking the can down the road. And the whole thing with the Roth is one big giant bet on future tax rates going up. So I think at some point that the math has to kick in. I don't know when that point is, but you don't want to be in the soup when the music stops. Take advantage of every year you can. Now, some people might say, matter of fact, we just had this in one of our meetings last week where somebody said, I have a client who is sure he'll be in a 22% bracket in retirement. So I reminded him that, okay, this was after I defined the word permanent in the program. I said, apparently I have to define another word, sure, about the future. Sure is only what you have right now. You can't apply that to tax law in the future. But I think that's a common myth, Tom, with retirees that think they will be in a lower bracket in retirement because maybe, and it makes sense in their mind logically, well, I don't have a W-2. Of course I'll be in a lower bracket. But what they forget is doing nothing is not an option. In other words, if you don't convert and take advantage of these low rates, your IRA continues to grow. That doesn't stop just because you didn't do anything. And for many people, they ignore that growth, that compounding of literally a debt. Remember, your IRA is an IOU to the IRS. It's a growing, building, compounding debt, and they ignore the snowballing of this debt. And then they haven't done anything. Then they think they're going to be in a lower bracket in retirement. Now they're 73, 4 or 5, and they're subject to RMDs, required minimum distributions. And all of a sudden, their income is higher in retirement because now they have this growing, building, this large IRA, and they're forced to take the money out. You never do well in taxes when you're forced into a certain tax bracket. The key with the Roth conversions, especially in your 60s, is you control the taxes you pay. You want to be in control. You can do enough of a conversion for, like we said, not to eliminate the SALT deduction and to stay in the 24% bracket. You can control it all the years up to when it's under the government plan. Now you're in RMD territory. It's out of your control. The key to tax planning is to always pay taxes at the lowest rates and be able to control the taxes you pay. Once you hit RMDs, it's out of your control and you're constrained.
Yeah, a couple of things that I always remind people of is just the point that you and John just recently made a little while ago was that there used to be about 20 different tax brackets. And
Yeah.
that's where that myth came in, where people would retire in a lower tax bracket. And we don't have that anymore. Those brackets are much wider. And then the other point that I always try to point out to people is, look, if you go from one tax bracket to a lower tax bracket, that means you're taking in less income, which means that you're living in a taking a lower standard of living. And is that why you worked, saved, and sacrificed all your working years so that you could live in a lesser lifestyle in retirement than you do in your working years? It doesn't make sense. Once you talk that through, does that really make sense? And the answer, of course, is no.
There was just an article in the Wall Street Journal a day or two ago on that, and it was, you might have seen it. It was called The Poor Person's Mentality.
Yeah, I did.
Yeah. And it's exactly what you said. All the things you're taking away from yourself so you don't run out of money.
Right. And when you're retired, you're not putting money into IRAs or 401ks. Your kids might still be living in your basement, but they're eating Skittles and playing video games, but they're not deductions anymore.
Right.
Right. Most people, they have their mortgage paid off.
Right.
So you don't have those kind of deductions. And so now everything is above line. Everything is taxable.
Right. And then we have another provision in the One Big Beautiful Bill Act, or which I again call the One Big Beautiful Opportunity, if you have the right advisor. But this one, I think, is a little overhyped. The new deduction for seniors, $6,000. Now, that sounds good because we have increased standard deductions now. We have, so they've been increased already for this year. And you have the 6,000 senior deduction, which if you're a married couple, both and each 65 or over, this is new for this year, you can each get the 6,000. So if you add it all up between the standard deduction, which increased, the extra standard deduction for being 65 or over, and the senior deduction of 6,000 each, you could have, if you hit all of those boxes, which most people 65 or over can do, you're going to have basically a standard deduction of 46,700 this year. That's the amount that won't be taxed. But here's the tricky part about it. It was billed or marketed or whatever you want to call it as the no tax on Social Security. That is not what it is. You get that deduction if you qualify age 65 or over, and there are income limits. I'll get to that in a minute. But if you qualify, you get that deduction even if you're not claiming Social Security. For example, say you're 65 and you qualify, but you decided you didn't want to take Social Security till you're 70 to get a higher check. Well, you still get the deduction. But here's the thing. You mentioned something, Tom, about above the line, below the line. Those are kind of tax terms. But this is what we call a below the line deduction, which means it doesn't reduce your adjusted gross income. So the amount of your Social Security benefits that will be taxable will still be taxable. This has no impact on that. The amount of your Medicare IRMA charges, those income-related monthly adjustment amount surcharges for Parts B and D, will be the same. This deduction doesn't change that. They're unrelated. For example, here's another one. Let's say you chose to get Social Security at 63 early. Now you're getting Social Security. Do you get this deduction? No, because it's only for people 65 or over. So it's not tied to Social Security. It is a deduction that can reduce the taxable income on all your income, whether you're not, even if you don't have Social Security income. And here's the thing with that senior deduction. For single, it cuts out at 75,000, starts phasing out, and 150,000 for married filing joint. So here's where this cuts in a little with Roth conversions. You might be thinking, oh, that senior deduction sounds good for me and my wife. Because it cuts in at such low levels, I looked at this. The highest rate you could be in at that level is maybe 22%. So the loss of a 6,000 deduction would only be loss of a tax benefit of about 1,300 or say 2,600 for the couple. Why am I saying the loss of that deduction? Because those are low levels. If you want to do a Roth conversion, I'm thinking it still might pay long term if that raised your income to the point where you didn't get this deduction. So those are the things you kind of have to balance. It sounds good. That is one that I would concede if you could do the Roth conversion, as opposed to the SALT deduction, which is a much bigger deduction that I might, and it's a much higher limit, 500,000. So that's one I might not, I probably wouldn't want to concede if a Roth conversion pushed me over.
And the quicker you do these conversions, right, the longer you have tax-free compounding interest.
Right.
And your quote is always, there's nothing better than tax-free money.
Yeah, I love tax-free. Nobody's ever argued with me on that. I've done seminars all over the country, as you know. Doesn't matter what your politics, everybody loves tax-free.
Well, and on that, because this bill also addresses estate planning, but I mean, how important does tax-free become when, your spouse dies and now you're a surviving spouse, or even the ability, if you're passing that money on to your kids in the 10-year deferrals?
Well, yeah, see, that's a problem with IRAs. The Secure Act did away with the long deferral for non-spouse, your children and grandchildren beneficiaries. They have to cash that out within 10 years after death. So that made IRAs a horrible asset, the worst asset for estate planning and wealth transfer, because all the tax is going to get hit in a shorter 10-year window. It used to be it was a good vehicle because you could go out 20, 30, 50, 60 years, depending on the age. That's gone. But you know what? I think the Secure Act, in a way, just incentivized us to do the better planning we should have been doing all along. IRAs were always a complicated asset to work with because of all the complex rules and the RMDs and the beneficiary rules. But we put up with it because of the long tax deferral. It had redeeming qualities. It no longer has redeeming qualities. In the beginning, we talked a little bit about baseball. Let me give you a baseball analogy. Let's say you have a guy on a team who's, I'm not saying anyone in particular, just a guy on a team that hits home runs, because there is no such person, hits home runs whenever you need them. Mr. Clutch, whoever that person is, especially in the playoffs, or especially when it's bases loaded, or especially in the World Series. The guy can always hit home runs. The problem is nobody on the team likes him. He's a horrible person. He's involved in every scandal. He's on drugs, alcohol, substance abuse. He does every horrible thing, but he can hit home runs. Now, if one day this guy comes into the locker room and says, I can't hit home runs anymore, he's gone. That's an IRA. You can't hit home runs anymore.
Quite the analogy.
But it's got no more redeeming qualities. You only kept it, you dealt with all the problems around it because you got what you wanted.
So, staying in the baseball vein, I'm going to put one on a tee for us. What is the best vehicle for estate planning and tax-free money?
Why is this a baseball thing?
Because I'm putting it on a tee for you to hit.
Oh, okay. I didn't get the
You gotta watch Tom. He's so witty.
To be honest with you, I stopped T-ball at 5 years old. I'm talking about real baseball here. I'm not talking about, Aaron Judge coming out and hitting off a tee. All right. I wasn't thinking that way.
All right.
Maybe he did once, but I don't think he does it anymore.
All right.
You teed it up for me. So the big winner is Roth IRAs and permanent life insurance. And again, I don't sell life insurance. I don't sell stocks, bonds, funds, insurance, annuities, none of that. I'm a tax advisor. But as a tax advisor, I'm telling you, the single biggest benefit in the tax code is the income tax exemption for life insurance. There's nothing like it. I'm not saying it's for everybody, but everybody with a large IRA, that IRA is a sitting duck for future taxes. You should do everything you can to bring those balances down now. Put it into Roths or permanent life insurance, cash value. I did this myself. That's why I get so excited when I talk about it. In fact, even in my book, The Retirement Savings Time Bond Fixed Louder, I changed, in the newest version, I changed the title after the Secure Act of my life insurance chapter. Now it reads, The Power of Life Insurance. Larger inheritances, more control, and less tax. That's what everybody wants. And where I said IRAs are now the worst possible asset to have for wealth transfer and estate planning, they're also the best asset to leverage into tax-free vehicles. You want to get to the promised land. Everybody likes tax-free.
Absolutely.
Well, and Tommy, I know you're probably salivating at this, but Ed, you can also talk. You mentioned, the tax-free benefit for estate planning. There's also tax-free benefits for retirees.
That's right, right. Look, the last thing you want to be in retirement, remember the guy, this was an advisor at the program, Tom, that I said, that had said he's sure his client will be in a lower bracket in retirement. You can't be sure. You're sure of what the rates are now. You want to lock in these rates now. That's the only thing we're sure of. And if you lock in these rates now, you don't ever have to worry in retirement about if future higher tax increases will take away from your style of living in retirement.
And not only for you in retirement, but if we're going to talk about legacy planning and your kids and your grandkids, at the end of the day, when mom and dad, they don't spend down that IRA and their kids get it to split, that taxes, you're going to make the government your largest inheritor of that qualified account a lot of times, especially, you have one or two children, at least a half or of a third of it is going to the government.
In some cases, maybe more. That's going to be where it ends up. Although, as a parent, you know what? I'm not that worried about the kids. To me, whatever they get is gravy.
Mm-hmm. Understood, but you're going to get something.
Right, right. Whatever they get is gravy. That's why when parents say, "Can I spend my money?" Yes, spend whatever they get. Whatever they get is gravy. But you're supposed to enjoy your life. You should never be worried about uncertainty, instability. You have what you have now. We have low rates, and that's what it is. You can deal with you'll never have to deal with the uncertainty of what future higher tax rates could do to your standard of living in retirement. Nobody wants to worry about that. Imagine going into retirement. Let's say somebody did just the things we talked about over time, did all Roths, had life insurance. All of their money will be available to them during their life, even the life insurance with the right policy, all tax-free if they need it. They never have to worry about the government raising taxes. In fact, if you have something tax-free, anything tax-free, whenever tax rates go up, anything tax-free becomes immediately more valuable.
And not only that, we talk about creating guaranteed income streams.
Right.
And all of those can be tax-free. And so when you wake up every January 1st of every year, you're getting a tax-free paycheck that pays all your bills. And, what does Tom Hagner say? Basically every day is a Saturday for you.
Right. Plus, you're in control. You don't have to take the money, for example, with the Roth IRA or the funds in the life insurance if you don't want to. But if you want to, it's there. It's not going to change your tax situation.
Right.
And the powerful compounding of, we talk about compounding gains on investments, but
yes.
What about compounding gains on taxes? You have tax-free income, and then what does that do? It perhaps reduces your taxable liability in Social Security or eliminates it. It reduces your taxable liability with Medicare and IRMA, reduces your RMDs or eliminates them, and then passes on that wealth tax-free. That's compounding.
Yeah. And there's a strategy. I'm not saying everything. For example, some people, I tell them to keep small amounts of IRAs. They may want to, one thing IRAs are good for, other than to leverage, like I said, is to give to charity if you're charitably inclined. Because they're such horrible assets, it doesn't matter to charity, they don't pay taxes. So if charity is in your plan, save some IRAs for that. You might also want to keep a small IRA because with the larger standard deduction, if you can take out, I don't know, 30, 40,000 a year, you still won't have any tax. So you can keep some of that to take advantage of the big standard deductions with no taxes each year.
Right.
Hey, and Ed, since you mentioned charities and with the big, beautiful bill, we've helped out some clients that, were over 70 and a half. They were very giving to their charities, their church, but they were giving out of their bank accounts. And we said, stop, let's reroute that. Let's do QCDs. Can you talk about the power of charitable planning and what our listeners should really, especially, if they're under 70 and a half with this big, beautiful bill, and even furthermore with QCDs above 70 and a half.
Well, some of the charitable provisions kick in next year. The charitable deduction for non-itemizers could be as much as 2,000 for a married couple. That's something new. We used to have it a few years ago at 300 and 600, and they changed it to 1,000 and 2,000, which is good for non-itemizers. So you could almost plop that on top of the big standard deduction. But charity, just a word about charity. When we talk about giving to charity, I never say do it for the tax reasons. You do it because you want to give to charity. I never tell people, I know, and my colleagues, a lot of CPAs said, no, there's big tax benefits. I found in my career that if people give just for tax benefits, they're always sorry they gave because they didn't really want to. When you tell them, oh, you get all these benefits up front, but then you have to actually give away the property. What? So it's if you normally give to charity, you're charitably inclined, and yes, the IRA is the best asset to give through qualified charitable distributions, QCDs. And that's another item that can reduce the income from your RMDs, and that's an above the line deduction because it reduces your adjusted gross income. The only problem with QCDs, I think it's one of the best provisions also in the tax code. Unfortunately, it's only available to IRA owners who are 70 and a half years old or older. So a lot of the population is out on that. I don't know why they did that. Charities would get a lot more money if they just opened it to everyone, but you have to be 70 and a half. But if you are, and even though some people listening might say, but I thought the RMD age went to 73. It did. They never coordinated it with the 70 and a half. So it's the only 70 and a half left in the tax code. I thought they got rid of all those 70 and a halves. So you can do them even before you start RMDs. But once RMDs start, if you normally, like you said, write a check to charity, don't write a check, do a direct transfer from your IRA to the organization, charity, school, whatever institution that you want to right out of your IRA, and it can satisfy your RMD at no tax.
I'm going to go off subject a little bit here, and I want to talk about rollovers, 60-day rollovers, because I'm still running into people. I know, right? We're on audio only as an audience, but I can see Ed grabbing his head, and I think he's breaking out into a fever at this stage.
Yeah. Well, because people are not well informed. Rollover, when you move money, say you're leaving your job from a 401k to your IRA, only do direct rollovers, also called direct transfers or trustee to trustee transfers. When the money goes right from one IRA to another or from one 401k to your IRA without you touching the money in between. Now I'll switch to football, okay? We had enough of baseball. Football's coming up soon anyway. A famous coach once said, and I never say the name of the coach because whenever I say this, everybody in the audience says it's their college coach who said it. He says, when you throw the ball, 3 things happen and 2 of them are bad. Who do you think said that?
Vince Lombardi.
Madden?
No, nobody knows. Everybody says Woody Hayes from Ohio State, but there's some people say from the University of Tennessee. Anyway, when you throw the ball in football, 3 things can happen, and 2 of them are bad. When you do a rollover where you take control of the money, not a direct transfer, 3 things also happen, but they're all bad. Nothing good can happen. You have the 60-day rollover rule, the once per year IRA rollover rule, and if it comes from a plan like a 401k, mandatory 20% withholding. So if you come out of your 401k in retirement with 500,000 and you don't do a direct transfer, say to your IRA, and you say, I want a check made out to me personally, your 500,000 balance, you know what your check will be? 400,000. Who took 100,000? They didn't take it. They sent it to the government, 20% mandatory withholding. But now, unless you have 100,000 laying around somewhere, you can't complete the $500,000 rollover. So you're actually going to have a tax on the tax withheld. That's a big problem.
And I'm still running into people who are taking IRAs from different accounts and trying to move them from one account to another, all by themselves, and not doing these transfers, company to company transfers. And I don't understand what some of the thought process is, but people are getting killed.
I don't know. They're getting bad advice. You might hear behind me. We're across from there's a fire truck coming by. Do you hear those sirens?
No.
All right. Well, it would have been a good sound effect. So don't do, it happens every now and then. There's a firehouse down the block and one of the trucks just went by. So sometimes if I hear the sirens and I think it's seeping through this podcast, this recording, I say, that's how important this is. It's a 5-alarm item here. Don't do the 60-day rollovers where you take a check, do direct transfers. You won't have any problems. And for example, the once per year IRA rollover rule, that is a rigid, irrevocable rule. I'll give you a horrible example, extreme, but let's say you roll over $500,000 from your IRA to another IRA by doing a 60-day rollover. You take a check out, made out to you personally, and you bring it to another IRA. That's fine. And then you find out that a few days ago, you just did that with a small IRA you were cashing out for $10,000. You did it, say, a week or 2 months before, and you forgot about it. Now that $500,000 becomes a taxable distribution, and there's no fix for it. You just lost your IRA.
And if you're under 59 and a half, you pay a 10% penalty, right? I mean, it's a disaster.
Yep.
So only do direct transfers. If you got that one thing out of this, and you got plenty more, hopefully, and the big item, the theme for this program is look at the big picture, where you want to end up at the end. Don't look at what it costs now. If anything, pay more tax now because you can get it out at lower rates. Don't think you're saving money by avoiding taxes now. Always pay taxes when the rates are the lowest. And we have it now. We have it for a few more years, maybe permanent, whatever that means. But get that money out of that horrible account, that IRA, while rates are low. You'll always end up with more money in the grand scheme of things at the end of the game.
Right.
Well, Ed, as always, ton of information in a short time. We appreciate you taking time out of your busy schedule. Folks, if you want more Ed Slott, visit his website, www.irahelp.com. They have tons of information on there. You can also visit that website, subscribe to his newsletter that he's got for consumers. And you can also buy his not so new book. But still, I still feel it's very relevant. Ed, would you say it's still very relevant?
Yeah, it's about 90% there. You know, obviously, we just had the new One Big Beautiful Bill Act, so that's not in there. But the core concepts are the same. The big picture, get that money out when rates are low, have more, keep more, and make it last. That's the bottom line with your retirement savings.
And Ed's on all the social media sites, Facebook, LinkedIn, his group is blogging at least once a day. There seems to be always something coming out, relevant, up to date. You know, as soon as they get information about something, they're out processing it for the consumer.
Including over the July 4th weekend when we sent you that alert on the new law.
Yep, I got that. That was some great holiday reading.
Beach reading, right? 870 pages of taxes.
Exactly.
Yeah.
Well, and 870 pages, like Musk tweeted out a couple of months ago, the tax code is 80,000 pages of opportunities that most people don't use.
That's exactly right.
So, well, Ed, thanks again. Again, everybody listening, we appreciate you taking the time and having one of our most famous guests on, and we encourage you to go to his website, get his newsletters, and stay informed. Tommy, great podcast. It's great being back on the show with you after a couple months. It's been a busy year for both of us. Right. And that's it. I'll be on vacation here coming up pretty soon. And we hope everybody enjoys their summer until the next time on the Retire Happy podcast.
Thanks very much.
It's easy to get in touch with John and Thomas. If you're more on the West Coast, give John a call at 858-758-9889. That's 858-758-9889. or go online to gosecurus.com. That's gosecurus.com. If you're more of an East Coaster, then call Thomas, 973-394-0623. That's 973-394-0623. And online at internationalfinancial.com. That's internationalfinancial.com. And you can, of course, always just check the description of today's show for all that contact information. Don't forget to subscribe and follow the podcast on your favorite apps, and we'll see you next time on the Retire Happy Podcast.
Investment advisory services offered through Brookstone Capital Management, LLC, BCM, a registered investment advisor. BCM, Securus Financial, and International Financial Advisory Group are independent of each other. Insurance products and services are not offered through BCM, but are offered and sold through individually licensed and appointed agents. The opinions expressed by John Amarino, Thomas O'Connell, and guests on this show are their own, and are based upon information considered reliable, although it should not be relied upon as such. Any statements or opinions are subject to change without notice. Investments involve risk, and unless otherwise stated, are not guaranteed. Past performance cannot be used as an indicator to determine future results. Any strategies mentioned may not be suitable for everyone. Information expressed does not take into account your specific situation or objectives, and is not intended as recommendations appropriate for you. Before acting on any information mentioned, please consult with a qualified tax or investment advisor to determine if it is suitable for your specific situation. This program is designed to provide accurate and authoritative information with regard to the subjects covered. Registered investment advisors and investment advisor representatives act as fiduciaries for all of our investment management clients. We have an obligation to act in the best interest of our clients and to make full disclosure of any conflicts of interest. Please refer to our firm brochure, the ADV 2A Item 4, for additional information.
Ed Slott and Company, LLC, is the nation's leading provider of retirement tax education for financial advisors, CPAs, and attorneys. Backed by a team of nationally recognized experts, including CPAs, attorneys, and retirement specialists, the firm delivers ongoing in-depth training on the latest tax laws, IRA planning strategies, and retirement distribution rules. Its flagship program, Ed Slott's Elite IRA Advisor Group, is comprised of 500 of the nation's top financial professionals who receive semi-annual live training, monthly updates, and case law analysis to help clients keep more of their retirement savings. Visit irahelp.com for more information.